Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for January 14th, 2023. We have a three-day weekend this weekend, so I hope you guys all enjoy it and don't spend all your time thinking about stocks in the stock market. But we'll try to keep this one a little shorter, but let's go ahead and get started. So we had a pretty big change over the last week to the positive, and we had a follow-through day in the market, and now we're getting some pretty strong upward action in all the indexes. And so we've moved now. The market trend is definitely in an uptrend, a confirmed uptrend. The market count is now risen from 0 just a week ago to 4 out of 5 for the NASDAQ and S&P. So our market exposure is now 90%, and that's if you're in the QQQ or the SPY. We don't have any institutional selling days, which is great. So there's no sign of institutions selling into this rally. And the power trend is off just because the trend is just turned up, and we don't have all of the data points that would turn the power trend on yet, but that could happen. And the only thing we have a red light here is that for individual stocks, they're just not acting all that great yet. Though we're getting the signs that they're improving and showing some of the better action we've seen, in quite some time, but we're not quite there yet. So that's our caution there. But for index investors, it's looking pretty good. And just going back to the individual stocks. A lot of this rally has just been driven by the FANG stocks and the big cap tech stocks. Money's flowing back into that for good or bad. That's what it's doing. And so not so much into leading stocks is what we're always looking at. That's what the individual stocks, non-index ETFs, action signals for leading stocks. Those are stocks that are at or near new highs already and breaking out. Okay, so for our investing strategies, we've had a pretty big move up already, 5.45% in the QQQ if you're in the buy and hold. And then our two investing strategies are underperforming a little bit just because we didn't actually get invested right away. It's kind of how our system works. We have to have certain technical things happen. And so we've been a little less exposed than if you just bought everything and buy and hold. But we'll definitely get less volatility using our system, and I'm sure it'll actually catch up pretty soon. Same thing for the SPY, a little underperformance, but no big deal. And then in terms of the strategies, we are showing both of them, but since we're still in a bear market, though technically we're in an uptrend, we're still kind of giving you both choices. You could use the 1x just for less risk, or the 2x, which of course is double the leverage. So we'll see what happens. And then we still have another sort of a composite strategy. It's almost ready, all the data. It's taking for a lot of time to get it all done. So that's going to be showing up pretty soon. Okay, so let's look at the indexes. The Dow Jones Industrials is definitely acting the strongest. You can see it back in November broke above the 200-day and it stayed above the 200, and at times kind of came down, hugged the 50-day, which is this red line, and has come back up again. So it's actually looking pretty strong. The 200-day is still in a downtrend, but it looks like it's actually leveled off a little bit and may be able to turn up here. So this is definitely the strongest of the indexes. Next is the next strongest one, I'm going to skip ahead, is the Russell, which is actually now had 3 closes above the 200, and it's trying to get above this resistance level here, call it 1900. But again, we're in a downtrend. It's definitely still a downtrending 200-day moving average, but is showing more strength than usual. And we've had some nice accumulation days over here. If you go to the S&P, so the next strongest, it's right at its 200. It just closed above it. Interesting, couldn't get above 4,000. Doesn't really mean anything, but sometimes those round numbers act as like magnets. And so we'll see what happens. This has been, market's been unable to get past this for more than a few days in the past. We'll see if that's going to change. Volume's been a little on the low side for this too. So a little bit of a warning there. And then we have the NASDAQ. Money's been flowing back into this. You can see here from the volume, but still really weak. In the weakest of the indexes, the downtrend is still, very much intact. This is still a bear market move. In a rally within a bear market move. But we have cleared the 50-day, which had flattened out here, and it's looking stronger. So, but we'll see. It's still range bound. You can see here since October, the market's just kind of been sitting within this range here, and whether or not we can blast above it and make this a much bigger move, remains to be seen. So let's take a look at the technicals now. So we're getting some pretty good improvements here. Maybe too much too soon. So one of the things we've seen is, the first thing is we have the percentage of stocks above the 200-day, and we're at 53%. We have not seen this since I think 2021, somewhere in there. Long time. This was down for a long time, in the 20s, in the low 30s, even below that. I think we went down to the teens at one point. So this is really a big improvement, which is showing that more and more stocks are starting to, move out of just sort of that. It's not really a bear market delineator, but a lot of people use it. If it's below the 200-day, don't ever buy it. If it's above it, then you can consider it. We're starting to see, though, for the first time in a long time, the 52-week highs are outpacing, and we really had a huge move up in the ratio on Friday. We can see we were just solid red for a long time. If you look at the big database, this goes on for many months and weeks, or weeks and months. And now suddenly we've turned up. The NASDAQ is above its 50-day and approaching the 200, markedly improved from just a few weeks ago. And we're also starting to see more growth stocks that are starting to break out and hold. That had really, it's been a tricky one, because not long ago, I think in November, we went up in the 90s or the upper 80s, and then we came straight all the way back down. Even as the market was improving a little bit, the breakouts just weren't working, and now we're going in for another run. And we're also seeing an improvement on the up and down volume. You can see here, just glancing at it, we're getting some more green and moving away from the red. And also we're starting to see some, pretty much more decent moves up. Like here we had 15, 7, where, these are strong up days or up volumes. So this is all markedly improved. So we want to continue to see that and not just break down. In terms of the sentiment, now this we're going to look at in a second too, but we finally have moved off the solid red on the VIX, and we're down to 18.35. That may be problematic, which we'll talk about in a second. But we're starting to see the sentiment has moved away. We're actually getting now much more towards the greed side. This hasn't been updated. This comes out on Wednesdays, and this is a little bit of a lagging one too. But we'll see. We're sort of starting to move up into kind of the no man's land, but more towards greed, where sentiment doesn't really have as much of a impact. But we still track it. But we may have come too far too soon. We'll see. But if we look at the whole overall picture, the market is looking pretty good, with the exception of the leading stocks are just not acting all that well. So, as I pointed out in our note on Friday, we're kind of one of the most dangerous points in time in the market, is that the market is trying to discount the end of the bear market, and we started a new run. They're trying to discount that the Fed's going to be done with the raising interest rates, and the worst is behind us. And now there's a couple arguments that, is the bear market over? Are we going to be in a big move up, or is this just another fake out that's going to end and the market going nowhere or making new lows? I mean, some people have argued that the Nasdaq has already experienced such a decline in growth stocks. I mean, many just went down 60 to 90%, that it's already discounted the worst conditions that it was looking at in terms of their price and evaluations. And maybe now that interest rates are going to be leveling off, at least the hikes won't be as steep as they were, then the worst is behind it. So in other words, we last saw this kind of destruction in growth stocks, back in 2000, when and that lasted a lot longer. But we had some similar declines in stocks, maybe a lot worse in some names, where a lot of them went down 90% or went bankrupt. So there's that part of the market's thinking, well, we've already discounted all that, and that's the bottom. So, but we'll see. We don't know. All we can do is look at what's happening, and then determine where that's going in the future. So, a few things we have to kind of be watching here, because we're at that kind of that dangerous point in time. And the first is that the S&P is back to hitting its 200-day, which has been resistance since April 2020. And you can see here, we did get above here in March, but March was sort of the beginning of the bear market. Nobody really thought it was going to be much more than a little correction here, but it wasn't able to hold above. We came up here in August. We almost exactly hit the 200, and the sellers just were waiting for that. Came down a couple tries here in December, wasn't able to hold, and here we are going for the fourth one. We could hold above it. We just don't know, but it's a warning sign right there that it's something that this is where the market has turned around in the past. A bigger one here is the VIX is at levels where the market is reversed throughout 2022, and I'll sort of explain this chart. It's a little messy here, but the VIX is actually at 1835. A little different in my numbers here. So let me just change it there. So what this is happening in the red zones here, you can see the low in the VIX. The VIX is the blue and pink line, the lines in the bar chart lines. And then we have the S&P, which is this black line. So you can see here, here's the beginning. This is January when the bear market was just starting, but nobody knew it was coming, really, even though we were coming out of a bubble. So it was kind of apparent we were going to have probably a bigger decline than what people were thinking. But you can see the VIX got down to like 16, and that was very low. And then market declined. When it got down to 18, that was the peak of the S&P again. Then we came down to 19. That was the peak over here in August. And then we came down to call it 19 again. That was this little peak here in December. And now we've actually broken below those peaks. And is this the top again? It's almost saying that as volatility gets that much lower, that it's peaking out in terms of that's the bullishness, and the buying is exhausted itself at that point. So we'll see. These are just warning signs that we may be a little extended at this point. Now this could be that it just keeps dropping, which would be actually very, very good for the market. Because just going back to this VIX here, this has been solid red for over a year, and it's just showing that volatility has just been very, very elevated for a long, long time. And it normally when you get up into the 20s, we're talking going back to a decade ago and going forward, the 20s, upper 20s was actually the top, and it would just drift back down, sometimes to as low as I think 12 or 13, down in the low teens, where that would be almost like it was getting a little frothy, and so we would kind of pull back. But it would be nice to see less volatility no matter what happens. But we'll see if that will correspond with higher stock prices, and we don't know at this point. But this is a little bit of a warning here, at least for the short term. The same for the S&P. And then finally, we have a little more concerning on the bigger side is the market's acting like interest rates that have gone from basically 0 to 3.5% on the 10-year or to 4.69% on the 1 year. It just has no repercussions. It's just, well, it just happened and off we go. And you have to remember that there was this trillions of dollars of debt was put in place, at or near 0%, because we had 0% interest rates, for a decade. This didn't just start at the end of COVID, around COVID times. It went back much farther. Because of all the quantitative easing, the Fed just pushed rates down to basically zero and held them there for, I think it was more than a decade. I think it started in 2012, if I'm not mistaken. So now all this debt is either in place or it's resetting, and it's resetting at a much higher rate. That just, you can't have no repercussions from companies borrowing that amount of money and then basically is no interest, and then now having to pay much higher rates. That, of course, will weigh on earnings. We're also getting a lot more warnings from companies, even though the market has been, especially on Friday, we had warnings from some of the big banks and the market just brushed them off. We're getting earning estimates are being reset finally. That can't have any kind of just negative. And they weren't coming from such low levels that there's now we're doing everything's just beating them. We're coming from higher levels that are now being reset lower. So these are the warnings going on. We may have come too far. We are some of the levels are showing that the market's overbought here on a short-term basis. So a pullback here would be constructive as long as it's not giving us a lot of distribution or institutional selling days. We don't want to see them within a week of the market going to a new uptrend. That usually turns to be the end of the uptrend. So that's what we're watching here. And then finally, the individual stocks, they're just not acting all that well. Though we're getting a little bit of some decent action, but they're not really. In our stock pick service, we've talked about we're getting more breakouts, very, very positive, but they're not going anywhere. There's very few stocks that have even gone up 4 or 5%. They're kind of going up, and then they're just 2-3%, and then that's kind of it. Now it's better than them going up 2% and then immediately reversing and stopping us out. So we're in that inflection point. We don't know what's going to happen, so we still have a little bit of caution. Except if you're an index investor, you're basically close to 100% invested, and we'll see. So, and this final thing I just want to say, we will probably still continue to expect volatility. We are in earnings season now, started, and be careful if you own stocks that where your when the earnings dates are, so you don't get caught in surprise. There will be a lot of blow-ups where the stocks will gap down 10, 20% or more, and you'll be if you're on the other side and you're lucky, they go up 10, 20, 30% or more. It seems to me the stocks that I own, I've seen more explosions to the downside than the upside when I've been holding a position through earnings, but that's just how it goes. Okay, well, that's it for this week. We'll be back next week. Again, enjoy the long weekend, and we'll be back on Tuesday. Okay, thanks.